Welcome back to the deep dive. It is February 25, 2026. We usually ease into these things, but we just have to start with the number on everyone's screen right now.
You mean the silver spot price?
Right. I mean, silver hitting an all-time high of $121.64 earlier this month. It's just a historic move.
It really is. And frankly, the speed of that repricing caught almost everyone completely off guard. A 320% gain in roughly a year is it's not normal.
No, it's not. But looking at the research you pulled, this isn't just a random volatility spike. It looks like an identity crisis for the metal itself. For decades, silver was just gold's volatile little brother, a monetary hedge.
Exactly. But the data from 2025 and early 26 shows a hard pivot. Silver has effectively graduated from a speculative asset to a strategic industrial mineral.
And it's trading on physical scarcity now instead of just interest rates and inflation. Which brings us to the demand side. The green trinity.
Right. Solar, EVs, and AI.
Let's drill down on the solar aspect first, because the narrative really flipped there. For years, the bear case on silver was thrifting, right? The idea was that engineers would just figure out how to use less silver paste in every panel to cut costs.
Theoretically, sure. But physics kind of got in the way of that. The industry is shifting rapidly to polysilicon and HJT solar cells. Those are high-efficiency technologies. And to get that extra efficiency, they actually require up to 50% more silver than the old PERC cells.
So the efficiency gains actually increase the metal consumption. That's a massive backfire for the bears. And you can't just engineer the silver out without sacrificing the performance.
You really can't. And electric vehicles are using 25 to 50 grams of silver each, which is almost double a gas car. Then you layer on the AI demand.
Right. I was reading about the data center infrastructure. It's not just the chips, it's the connectors. Silver is the most conductive metal on the periodic table. When tech giants are building these massive server farms, heat and resistance are the ultimate enemies.
And those tech giants are completely price insensitive. That is the key here. They don't care if silver is $30 or $130. The cost of the metal is just a rounding error compared to the value of the AI running on it.
So you have this inelastic demand from the biggest companies on Earth. The logical market response should be a mining boom, right? If I'm a miner and silver hits $100, I should be digging every hole I can find.
But looking at the geological data, that just isn't happening. This is the byproduct problem, and it's probably the most critical constraint to understand.
Because 72 to 80% of the world's silver isn't mined on its own.
Exactly. It comes out of the ground as a secondary asset when you're mining copper, lead, or zinc.
So silver is essentially the bonus metal. If the price of zinc is flat, a miner isn't going to ramp up a billion-dollar operation just to get a little extra silver on the side.
Precisely. The supply is structurally inelastic. We are looking at a projected deficit of 67 million ounces for 2026. That is the sixth year in a row the world has burned more silver than it found.
And that deficit was essentially the kindling.
Wow.
Then January 1st happens, and China throws a match on it.
The China shock. We knew China controlled about 70% of refined capacity. But the export controls they slapped on refined silver were aggressive.
They looked at their own domestic needs for solar and AI dominance and decided to ring-fence their supply.
Which explains the volt train we saw in London and New York. It wasn't just speculators, it was Western manufacturers panicking that they wouldn't be able to get metal to keep their lines running.
It created a split market. Western manufacturers are now scrambling for metal, establishing this high price floor around $87 to $90. Which brings us to the investment side, which is tricky. The sources highlight a massive disparity between paper silver and the actual metal.
It's the leverage risk.
Yeah.
The estimated ratio is roughly 356 paper ounces futures, ETF contracts for every 1 ounce of physical silver actually sitting in a registered vault.
356 to 1. That sounds like a game of musical chairs where 300 people are fighting for one single seat.
That's the worry. If confidence breaks and those paper holders demand delivery of the metal, the math simply doesn't work. That's why you see that premium on physical bars right now, despite the storage headaches.
Or people looking at the pure play miners, companies like First Majestic or the streamers like Wheaton, trying to get exposure to the price without renting a forklift.
Right. But the bottom line from all the material is that the sub-$30 era is dead. The market is pricing in permanent scarcity.
Which leaves you, the listener, with a really difficult question to ponder as we wrap up. In a true shortage, the market has to decide who goes without.
It does. And that is exactly the conflict we are watching unfold now.
If there isn't enough silver for everyone, who wins the bidding war? Is it the investor trying to protect their wealth, or the AI factory that needs the metal to keep the lights on? In a battle between fear and utility, we're about to find out who blinks first. Thanks for joining us on this deep dive.